China is in crisis, not the kind they will admit, not the kind showing up in their official numbers, but the kind of crisis that builds quietly for years until things go wrong at once and everything that looked unbreakable starts to crack. For 30 years, China built the world's most powerful manufacturing machine, and the world had no choice but to depend on it. Now that machine is being squeezed from multiple directions at once. Every crack China cannot fix is a gap that opens somewhere else. And what China is losing grip on, India is tightening its hold on. This is not just China's crisis. This is the moment India has been building toward. On the surface, China's economy looks like the most formidable machine ever assembled. The largest manufacturing base in human history, the world's biggest exporter, the fastest infrastructure builder, the country that built more in 20 years than most nations built in 2 centuries. But there is a version of this story that the headlines do not tell. And it requires looking at different things happening simultaneously, three separate crises unfolding at three different speeds, each one serious on its own and genuinely dangerous when they overlap. And while China is managing all three simultaneously, one country has been quietly positioning itself to benefit from exactly the kind of crisis now unfolding. This video will show you numbers. Specifically, the gap between the numbers China shows the world and the numbers that actually exist. And once you understand that gap, everything else starts to make complete sense. And by the end of the video, you will understand why India is the country the world is now turning to. Here is something China does not want anyone to know. Its actual debt is not what it officially reports. Not even close. Officially, China says its government debt is about 68.5% of its GDP. That sounds reasonable, responsible even, but that number is missing several very large, very real obligations that Beijing simply chooses not to count. Here's how it works. In 1994, Beijing changed its tax system. The central government took the lion's share of tax collection. Local governments, states, and cities were left responsible for paying for roads, schools, hospitals, and local development. But they were not given enough money to actually do all of that. So local governments did what any entity does when it needs money it does not have. It borrowed. But instead of borrowing directly, which would show up on official books, it created separate companies. These companies took on the loans, built the infrastructure, and held the debt. On paper, the debt belonged to the company, not the government. So Beijing could say officially that this was corporate debt, not government debt. These entities are called local government financing vehicles. And the debt they are carrying is enormous. China's own Ministry of Finance admitted the hidden local government debt was 14.3 trillion yuan at the end of 2023. The IMF looked at the same situation and estimated the real figure was 66 trillion yuan, nearly 5 times higher, and approaching 72 trillion by 2025. Goldman Sachs put it even higher at 91 trillion. To put that gap in perspective, the difference between what China admits and what the IMF calculates is larger than Germany's entire annual economy. Germany. That is how big the discrepancy is. And that is just the local government piece. China built ghost trains to nowhere, borrowed money it hid in fake company names, and promised retirement pensions it never actually saved. China has hundreds of millions of people who were promised retirement payments. But the money collected from workers over the years was not properly set aside for them. It was used to pay current retirees instead. Now, with an aging population and fewer young workers paying in, the gap between what was promised and what actually exists in the pension system is estimated at 15 to 30 trillion yuan. Add all of it together. Total government debt is estimated at somewhere between 226 and 264 trillion yuan. China's official GDP is 140 trillion yuan. So the real debt to GDP ratio, when all the hidden obligations are included, is somewhere between 170 and 180%. Not 68.5%. 170 to 180%. Higher than the United States, higher than Japan, comparable to some of the most debt-burdened economies on the planet. Everyone owes everyone. Nobody has the money. And unlike a normal debt crisis, where at least the problem is visible, this one has been hidden so carefully for so long that even the full extent of it is still being counted. That is what 68.5% actually looks like when you turn the lights on. Now, some people will ask a fair question. If India is becoming the country the world is turning toward, why are foreign investors pulling money out of Indian markets? And the answer is important, because foreign money leaving Indian stock markets does not mean the world has stopped believing in India. It means something very different. A large part of that money is portfolio capital, fast-moving money that enters and exits stock markets based on valuation, currency movement, interest rates, oil prices, and short-term global opportunities. This is not the same as a company building a factory. It is not the same as Apple moving production to India or Japan, committing billions into India's long-term future. It is not the same as supply chains physically shifting from China to India. Foreign portfolio money is extremely impatient money. It comes when prices look attractive. It leaves when valuations look expensive. And India, because of its strength, has become one of the most valued major markets in the world. That is the irony. Some foreign investors are not leaving India because India is weak. They are booking profits because India has become strong enough, expensive enough, and valuable enough for them to cash out. There is also the rupee factor. There is the oil factor. There is global risk. There is money moving temporarily toward other markets because fund managers chase the next quarter, not the next decade. But none of this changes the deeper story, because the real question is not whether a foreign fund sells Indian equities this month. The real question is, where are factories and supply chains moving? Where is talent being built? Where is consumption growing? Where are global companies planning their next 20 years? And on that question, the answer is very clear. India is still where the world is looking. China's problem is different. In China, capital is not just rotating out of the stock market. Capital is trying to escape the system. That is why Beijing is cracking down on offshore brokerage platforms. That is why Chinese investors are being restricted from freely buying overseas assets. That is why reports of unofficial capital outflows from China running into hundreds of billions, even over $1 trillion, matter so much. Because China is not dealing with normal portfolio movement. China is dealing with a confidence problem. It is seeing its own citizens, businesses, and insiders look for exits. That is the difference. India is building confidence. China is trying to stop money from leaving. India is trying to build a country where the world wants to arrive. And in the long run, that difference matters more than any 1 month of foreign investor selling. This is the point at which India's strategic choices begin to look very different from China's. Both India and China are large energy importing economies. Both have to keep factories running, transport networks moving, inflation under control, and hundreds of millions of people protected from sudden price shocks. Both countries are exposed to global disruptions in oil markets. Both have to think seriously about the Strait of Hormuz, West Asian instability, shipping routes, sanctions, and the price of crude. But the way the two countries handled this vulnerability could not have been more different. China tried to hide the weakness inside a shadow system. India chose to manage the vulnerability openly, diplomatically, and strategically. That difference now matters. China consumes roughly 16 million barrels of oil every single day. It imports more than 70% of what it consumes. For years, Beijing tried to solve the cost problem by quietly building an alternative oil system outside normal global scrutiny. It bought cheap sanctioned crude from Iran and Venezuela through hidden tanker networks. Ships switched off transponders. Cargo documents were altered. Oil was transferred between vessels in the middle of the ocean. By the time the crude reached Chinese ports, its real origin had been disguised. On paper, that oil was not Iranian or Venezuelan. In reality, it was feeding China's industrial machine. By 2025, sanctioned oil reportedly formed a major share of China's total imports. This was not a minor loophole or a small workaround. It was an industrial-scale system that saved Beijing billions of dollars every year. It was so deeply embedded in China's energy economics that teapot refineries in Shandong province reportedly adjusted their operations around Iranian and Venezuelan grades of crude. In other words, parts of China's refining system became dependent on oil that China was not officially admitting it was buying. That is the danger of shortcuts. For a while, they look clever. They reduce costs. They create advantages. They make the system appear more efficient than it really is. But if the advantage depends on concealment, it remains vulnerable to exposure. And eventually, the world started pulling the threads. The United States sanctioned Shandong Shuguang Luqing Petrochemical, marking the first time Washington had directly targeted a Chinese refinery over Iranian crude. Then came action against other refineries in Shandong, which immediately halted Iranian purchases because they feared they could be next. Port operators began refusing shadow tankers. The pressure did not remain limited to oil. Panama's courts annulled the concession that allowed C.K. Hutchison, a Hong Kong conglomerate with deep mainland ties, to operate terminals at both ends of the Panama Canal. Panamanian authorities physically took control of the facilities. China threatened consequences, but the decision held. For Beijing, this was another reminder that infrastructure influence built through quiet leverage can become vulnerable when political conditions change. Then a vessel called the Centuries was seized in the Caribbean, carrying Venezuelan crude. Venezuelan oil flows to China reportedly dropped sharply. One by one, the hidden routes that had given China cheap supply began to face enforcement. Then came the shock that China could not control. On February 28, 2026, Operation Epic Fury, a United States-Israeli military campaign, destroyed Iranian naval assets and killed Iran's supreme leader. Iran responded by closing the Strait of Hormuz. Tanker traffic collapsed. Oil prices surged from $73 per barrel to $126. For China, this was a nightmare scenario. The shadow routes had already been weakened by sanctions. The legitimate Middle Eastern supply was now disrupted by war, and the strategic stockpile that Beijing had built through aggressive storage began to drain faster than expected. This is what happens when a country builds an energy system around concealment rather than resilience. The system works as long as no one interferes. And this is exactly where India's approach looks different. India also imports most of its oil. India also feels pressure when crude prices rise. India also has to protect its consumers, its industries, its fiscal balance, and its inflation outlook. But India did not build a hidden tanker empire or a shadow refinery network. When discounted Russian crude became available after 2022, India bought it openly. It negotiated directly. It explained its position clearly. It defended the policy publicly as a matter of national interest. The message was simple and firm. India is a country of 1.4 billion people, and India's first responsibility is to secure affordable energy for its own citizens. That was not evasion. That was sovereignty. And that is why the result was different. That difference becomes crucial when the global energy crisis deepens, because the oil shock is not hitting China in isolation. It is arriving on top of a much larger set of problems that were already weakening the Chinese model. It is arriving on top of the debt problem. A debt-heavy economy has less room to absorb an energy shock. Each crisis makes the other harder to manage. That is why China's problem is not simply expensive oil. It is expensive oil arriving at the exact moment when the economic structure underneath is already under pressure. This is the part that matters most because India's current position did not appear by accident. India is not benefiting merely because China is facing difficulty. India is benefiting because, over many years, it made a series of decisions that looked cautious, slow, complicated, and sometimes unpopular, but which now appear strategically correct. India faces many of the same vulnerabilities that China faces. But when India faced the same temptation China faced, India chose a different path. India could have tried to hide its purchases, disguise cargoes, or build informal channels that would become vulnerable later. It did not. India negotiated directly with Moscow, purchased Russian crude openly, and defended the decision in public. India clearly said what it was doing and why it was doing it. That clarity mattered. India bought the crude because it was available, affordable, and in India's national interest. As a result, Russia moved from being a small supplier in India's oil basket to one of the largest. India saved billions of dollars through discounted crude purchases. For more than 2 decades, India invested in Chabahar Port in Iran, on the Gulf of Oman. Chabahar is not just another port project. It sits outside the Strait of Hormuz closure zone and gives India a strategic access point toward Iran, Afghanistan, Central Asia, and Russia. In 2024, India signed a 10-year operating agreement for Chabahar, making it the first foreign port operation of this kind in India's history. That one decision tells you the difference in strategic mindset. Chabahar links into the international north-south transport corridor, a 7,200-kilometer network designed to connect India with Iran, Central Asia, Russia, and beyond. This is why India's presence on Iran's exemption list during the Hormuz disruption matters. China was there because Iran needs Chinese money. India was there because India had built a relationship, invested in infrastructure, and maintained dialogue through difficult years. That distinction is important. Leverage can disappear when conditions change. Trust, if maintained carefully, lasts longer. The same contrast is becoming visible in manufacturing. Every time China's energy costs rise, India's relative competitiveness improves. Every time China's supply chains appear less reliable, India becomes more attractive. This is why the China Plus One strategy is becoming an operational decision. Companies move because cost, risk, politics, market access, and long-term stability begin to point in a new direction. India has spent years building that direction. It has improved infrastructure. It has expanded digital systems. It has created production-linked incentive schemes. It has strengthened domestic manufacturing. It has built stronger diplomatic relationships. Most importantly, it has refused to lock itself permanently inside any one camp. That is India's advantage. It is flexibility. India's power lies in its ability to talk to Washington without abandoning Moscow, engage Iran without losing the Gulf, buy Russian crude without becoming isolated, attract Western manufacturing, and build domestic capacity without cutting itself off from the world. China's real problem is not that one thing has gone wrong. Every major country faces shocks. China's problem is that three pressures are now converging at the same time. The first pressure is debt. The second pressure is institutional rigidity. Over time, China's model has directed capital toward politically favored sectors, rather than always toward the most productive opportunities. The third pressure is energy, and all of this is happening while capital is looking for exits. China assumed that cheap energy would remain available. It assumed that growth would keep covering inefficiency. It assumed that the world would tolerate workarounds as long as China remained too important to disrupt. It assumed that control could substitute for confidence. All of these assumptions are now being tested. This is where India's position becomes powerful. India is not watching this as a spectator. It is positioned as the alternative. When China becomes expensive, India becomes more attractive. When China becomes risky, India becomes more credible. When China becomes closed, India becomes more open. And whenever China tries to control capital, India tries to attract confidence. This is not a simple story of one country falling and another rising automatically. India still has to execute. India still has to build. It still has to improve its infrastructure, labor systems, logistics, energy security, legal processes, manufacturing depth, and state capacity. But the direction of global interest is changing, and India is one of the few countries with the scale to absorb that interest. That is why India matters. There are many countries that are stable but too small. There are many countries that are cheap but lack scale. There are many countries that have manufacturing ambition but not enough domestic demand. India offers something rare: a large market, a young workforce, democratic legitimacy, strategic geography, expanding infrastructure, and a foreign policy flexible enough to work with multiple power centers simultaneously. The most important difference between India and China today is not just oil, debt, manufacturing, or diplomacy. It is optionality. India is extremely powerful right now because it has built options. And this is where India's position becomes increasingly important. India is not dependent on one camp. China's model became rigid because it was built around control. Control over capital, control over industry, control over supply chains, control over information, control over political outcomes. For a long time, that control made China look incredibly efficient. Decisions moved fast. Infrastructure appeared quickly. Factories scaled at impossible speed. But control has a cost. A system built on control can become powerful in stable times, but brittle in unstable times. When conditions change, it struggles to adapt because every part of the system is tied back to the center. India's model is slower, it is noisier, it is more democratic, it debates more, delays more, argues more, and often frustrates people who want immediate execution. But that same complexity gives India something China increasingly lacks: flexibility. India can correct course without pretending the previous course never existed. India can absorb disagreement without the system collapsing. India can allow private enterprise, domestic investors, state governments, foreign partners, consumers, courts, voters, and entrepreneurs to all push the country in different ways, and somehow, through that chaos, the country still moves. That is the part many outside observers misunderstand. India's democracy is often seen as a weakness because it looks messy from the outside. But in a world where authoritarian systems are discovering the limits of control, India's openness becomes an asset. It allows the system to breathe. It allows feedback to enter. It allows mistakes to be challenged. It allows capital, talent, and ambition to operate with far more confidence than in a system where every major decision ultimately depends on political permission. This is why India's rise should not be judged only by one headline, one quarter, one election, one market movement, or one temporary challenge. India's deeper strength lies in the fact that it is building many doors at once. Energy doors through Russia, the Gulf, the United States, and Iran. Trade doors through the Indian Ocean, Chabahar, the INSTC, and new supply chain corridors. Manufacturing doors through electronics, defense, semiconductors, pharmaceuticals, renewables, and automobiles. Diplomatic doors through the Quad, BRICS, the G20, the Global South, Europe, Japan, and West Asia. Domestic doors through digital public infrastructure, UPI, ADAR-linked systems, expanding highways, ports, railways, airports, and a consumer market that is still growing. This is not a country betting everything on one route. This is a country building multiple routes before the old ones break. And that is exactly what China failed to do. China built a giant machine, but too many parts of that machine depended on the same assumptions. Cheap energy would remain available. Global demand would remain strong. Debt could keep expanding. Capital would stay trapped. And the world would keep tolerating dependence on Chinese manufacturing. India did not build that kind of machine. India built room to maneuver. That is why every major global shift now seems to create a new opening for India. When supply chains become risky, India becomes relevant. When energy routes become unstable, India's long-term connectivity projects become relevant. When companies want China plus one, India becomes relevant. When the global South wants a voice that is not controlled by Beijing or Washington, India becomes relevant. When democracies need scale outside the West, India becomes relevant. And when the world starts asking which country can combine market size, young talent, political legitimacy, strategic geography, and diplomatic flexibility, India becomes almost impossible to ignore. That is the real story. India is not rising because China is falling. India is rising because it has spent years building the kind of optionality that a fractured world now desperately needs. China built control, India built choices, and in the world that is coming, choices may become the greatest form of power. If you made it to the end of this video, thank you, genuinely. Your time is valuable, and there are 1,000 other things you could have spent it on. The fact that you chose to spend it here means a lot to us, and it is not taken for granted. To the people who watch every video who have been here since the beginning, this channel exists because of you. Not because of algorithms, not because of viral moments, because a group of people decided that understanding India's place in the world was worth their time. Every view, every hour you gave, every time you came back, that is what built this. That is what keeps this channel going. And there is no way to adequately thank you for that except to keep making content that is actually worth the time you give it. To the people who engage in comments, you make every video better. And to anyone watching this for the first time, welcome. India is at an inflection point. The decisions being made right now, the strategies being executed, the relationships being built, they will determine what this country looks like in 2050. Understanding those decisions is not an academic exercise. It is the most important kind of awareness a citizen can have. Ask questions, share what you learn. The more people understand the world India is operating in, the better the decisions that get made on behalf of all of us. If this video added something to how you see the world, like it. Share it with a person who would value it. Subscribe if you want to keep following this story as it develops. And drop a comment telling us what you think India's biggest opportunity is right now. This channel reads every single one. India is building something. You are part of understanding what that is. Thank you for being here. Genuinely. See you in the next one.